Hello and welcome again. This is your host Harshit Sinha with another interesting topic under series of ESG investing in India related to asset under management. Asset under management is a measure to the total market value of assets that an investment company or a financial institution manages on behalf of its client. It is an important matrix used to gauge the size and success of an investment firm or fund. In India, the asset under management has been steadily growing, driven by factors such as rising incomes, increasing financial literacy, and a growing appetite for investment products. The status of asset under management in India has been experiencing significant growth in recent years, reflecting the country's expanding economy and increasing investors' participation in financial market. As of 2024, the mutual fund industries in India has been substantial expansion in asset under management. According to the Association of the Mutual Funds in India, the asset under management of Indian mutual fund industries have been steadily rising, crossing significant milestone in recent years. This growth has been driven by factors such as increasing financial literacy, a growing middle class, and the shifts from the traditional saving instruments to market-linked investment products. However, it is important to note that the asset under management growth has not been without challenges. Market volatility, regulatory changes, and global economic factors continue to influence investor sentiment and funds performance. But the exact figures would need to be verified with the latest data from Association of Mutual Funds in India or other authoritative sources. The overall trends indicates a positive outlook for the asset management industries in India. The industry's growth reflects the increasing financialization of saving in India and the growing sophistication of Indian investors. Now we shall discuss mutual funds, a driving force in India. Asset under management for mutual funds in India have significant growth in recent years, driven by several key factors. The first is increasing popularity. Mutual funds have gained substantial traction among the Indian investors due to their potential for higher returns compared to traditional saving instruments. The growing financial literacy in India has led to increased awareness about the benefits of mutual funds such as professional management, diversifications, and accessibility. Systematic investment plans, that is SIPs, have become particularly popular allowing investors to invest small amounts regularly, which has brought in a steady stream of investment. Next is related to the variety of options. The Indian mutual funds industry offers a wide variety of options to cater to diverse investors' needs and risk appetite. These include equity funds, debt funds, hybrid funds, index funds, and sector-specific funds among others. The introduction of new funds category by SEBI has further expanded the choice available to investors. Exchange Trade Fund, that is ETF, and the Fund of Funds, that is FOF, have also gained popularity, providing additional diversification options. The next is related to the regulatory reforms. SEBI has implemented several reforms to enhance transparency, reduce cost, and protect investor interest. This includes the categorization and rationalization of mutual fund scheme, reduction in expense ratio, and a stricter disclosure norm. The implementation of direct options, which offers lower expense ratio by passing distributors, have also attracted cost-conscious investors. The growing asset under management of mutual funds reflects the increasing financialization of saving in India and the growing confidence of Indian investors in market-linked investment products. Now we shall discuss insurance sector, a steady contributor. The insurance sector in India has a steady contributor to the country's asset under management, playing a crucial role in financial landscape. The sector's contribution to asset under management can be explored through its own main segment, that is life insurance and general insurance, along with the impact of regulatory changes. The first is related to the life insurance. Companies in India manages a significant portion of country's asset under management. These companies invest policyholder funds in various financial instruments, including government securities, corporate bonds, and equities. The long-term nature of life insurance policy allows for substantial fund accumulation over time. Products like unit-linked insurance plan, that is ULIPs, and endowment policy have contributed significantly to asset under management growth in this sector. The next is related to general insurance. While the general insurance typically deals with the shorter term policies, it still contributes to overall asset under management. General insurance companies invest their reserves and surplus funds in various financial instruments to maintain solvency and generate returns. The growth in segments like health insurance and motor insurance has led to increased premium collection, subsequently contributing to asset under management growth. The next is related to the regulatory changes being made. The Insurance Regulatory and the Development Authority of India, that is IRDA, has implemented various reforms to strengthen the sector and protect policyholder interests. These includes changes in investment norms, solvency requirements, and product regulation. For instance, regulations allowing insurance companies to increase their equity exposure have potentially led to higher asset under management growth. The introduction of new product categories and push of insurance penetration in rural areas have also contributed to asset under management expansion. The growing asset under management in the insurance sector reflects increasing insurance penetration in India, rising awareness about financial protection, and the sector's role as a key institutional investors in the Indian financial market. This slide discusses about alternative investment funds, that is AIF. The first is related to the emergence of alternative funds. In India has been a significant development in country's financial landscape. The AIF are privately pooled investment vehicles that collect funds from sophisticated investors, both domestic and foreign, for investing in accordance with a defined investment policy. The next is related to the regulatory framework for AIF in India was established by the SEBI in 2012. SEBI introduced the AIF regulation to create a structure for private pool of capital and provide a flip to startup funding. These regulations categorize AIF into three types. The first category deals venture capital funds, SME funds, social venture funds, and infrastructure funds. The second category deals with the private equity funds, debt funds, and funds for funds. The third category deals hedge funds, PIPE funds, and strategy funds. This framework has provided a structured approach to alternative investment, ensuring better transparency and governance. The next is related to the diversification with AIFs has been notable. While initially dominated by private equity and venture capital funds, the sector has expanded to include various strategies such as real estate funds, credit funds, and special situation funds. The diversification has attracted a wider range of investors and allowed for more sophisticated investment strategy. The growth of AIF has also played a crucial role in providing capital to startups, infrastructure projects, and distressed assets. They have become an important source of long-term capital, completing traditional funding sources and contributing to India's economic growth. As the AIF sector continues to mature, it is expected to play an increasingly important role in India's financial market by providing sophisticated investment options and supporting the country's economic development goals. Now we shall discuss portfolio management services. Asset under management in India has been experiencing significant growth, particularly in the portfolio management services sector. This growth is driven by increasingly demand of customized investment solution, professional expertise, and the benefits of regulatory oversight. The first is the portfolio management service offers high net worth individuals and institutional investors tailored investment strategy that align with their specific financial goal, risk tolerance, and the market outlook. This customization is a key factor in the increasing popularity of PMS in India as an investor seeks alternative to one size fits all mutual funds offering. The next is related to professional expertise is another crucial aspect driving PMS growth. Portfolio managers bring in-depth market knowledge, research capabilities, and experience in navigating complex financial landscape. This expertise is particularly valuable in India's dynamic and often volatile market condition where informed decision making can significantly impact returns. The third is related to the regulatory oversight by the SEBI provides an additional layer of confidence for investors. SEBI's regulation ensures transparency, ethical practice, and investor protection, which are essentially for building trust in PMS industries. It is worth noting that within the PMS asset under management, there is a diverse mix of investment strategies. Equity-oriented portfolio typically dominate, followed by depth and the balanced strategy. The flexibility to offer such diverse strategy under one umbrella is another factor contributing to the popularity of portfolio management services. Additionally, as regulatory framework continue to evolve and strengthen, investors' confidence in portfolio management services is expected to further solidify, potentially leading to even greater asset under management growth in the coming years in India. The much needed for every Indian is national pension system. The national pension system has emerged as a significant contributor to India's asset under management, offering a compelling combination of long-term saving, tax benefit, and investment growth potential. This government-sponsored pension scheme has gained traction among both public and the private sector employees as well as self-employed individuals. The first is related to the national pension system. Primary appeal lies in focus on the long-term saving for retirement. It allows participants to systematically invest throughout their working years, building a substantial corpus for post-retirement financial security. This long-term approach aligns well with India's demographic dividend as a large working age population seeks reliable retirement solution. The second is related to tax benefit. Tax benefit associated with the NPS have been key driver of its popularity. Contributions to NPS are eligible for tax deduction under Section 80C and additional deduction under Section 80CCD1B of Income Tax Act. These tax incentives make NPS an attractive option for individuals looking to optimize their tax planning while saving for retirement. The third is related to investment growth potential is another crucial aspect of NPS. The scheme offers a mix of equity corporate bonds, government securities, and alternative investment options, allowing participants to tailor their investment strategy based on their risk appetite and age. This flexibility, combined with professional fund management, provides opportunity for long-term wealth creation. Now we shall discuss about real estate investment trust in India, that is REITs. Real estate investment trusts, REITs, have emerged as a significant contributors to India's asset under management, offering investors a unique blend of diversification, liquidity and professional management in the real estate sector. Since their introduction in India in 2014, REITs have gained traction as an attractive investment vehicle, particularly for those seeking exposure to commercial real estate without complexity of direct property ownership. The first is related to diversification. It is a key advantage of REITs in India. They allow investors to access a portfolio of high quality income generating real estate assets across various sectors and locations. The diversification helps mitigate risk associated with the individual properties or specific market segment, providing a more stable investment profile. REITs typically include a mix of office space, retail properties, warehouse, and sometimes even a data center, offering a broad representation of India's growing real estate market. The next is related to the liquidity. Liquidity is another crucial aspect that sets REITs apart from the traditional real estate investment. Publicly traded instrument on the stock exchange, REITs offer investors the ability to buy and sell units easily, much like stock. This liquidity is particularly valuable in context of real estate, an assets class traditionally known as for its liquidity. The ease of the entry and exit makes REITs accessible to wider range of investors from retail to institutional. The next is related totally on the professional management. The professional management is cornerstone of REITs appeal. These trusts are managed by experienced team with a deep knowledge of real estate sector. They handle property acquisition, management, leasing and maintenance, allowing investors to benefit from real estate ownership without the associated operational challenges. This expertise is crucial in navigating India's complex real estate landscape and maximizing returns from the property portfolio. The success of REITs in contributing to India's asset under management underscores the importance of innovative financial products that bridges traditional assets classes with the modern investment needs. One of the most important point for asset under management is related to infrastructure investment trust, may be called as IITs. Infrastructure investment trusts have emerged as a significant component of Indian asset under management, offering investors a unique opportunity to participate in country's infrastructure growth story. IITs provides a platform for direct investments in infrastructure assets, combining the benefits of exposure to crucial sectors, a robust regulatory framework, and diversification. The first point is exposure to the infrastructure. It is the primary appeal of infrastructure investment trusts. They allow investors to access a portfolio of income generating infrastructure assets such as road, power, transmission lines, pipeline, and telecom towers. This exposure is particularly valuable in Indian context where infrastructure development is a key driver of economic growth. Infrastructure investment trusts provide a way for retail and institutional investors to participate in large scale of infrastructure projects that were previously accessible only to large institutional investors or government entities. The second is related to regulatory framework. The regulatory framework governs infrastructure investment trust in India is designed to ensure transparency, accountability, and investors' protection. The SEBI has established comprehensive guidelines for infrastructure investment trust, covering aspects such as asset valuation, distribution policies, and governance structure. This robust regulatory environment has been crucial in building investors' confidence and attracting both domestic and foreign capital to the infrastructure sector. Third is related to diversification. The diversification is another key advantage offered by the infrastructure investment trusts. They typically hold a portfolio of assets across different infrastructure subsectors and geographical location, helping to mitigate risk associated with individual projects or specific regional economic condition. This diversification is particularly valuable given the long-term nature of potentially volatile of infrastructure investments. Now we shall discuss about sovereign wealth fund. The sovereign wealth fund, that is SWF, has emerged a significant player in India's asset under management landscape, offering unique potential due to their government-owned nature, long-term investment horizon and diversification strategies. While India itself does not have a prominent SWF, it has become an attractive destination for foreigners SFW looking to invest in the country's growing economy. The first is related to government-owned nature is defining characteristic of SWF. These funds are typically established by governments to manage national saving, foreign exchange reserve or revenue from natural resources. This government backing often translates to substantial financial resources and a focus on strategic long-term investment for India. This means access to large pool of patients' capital that can be deployed in a critical sector of the economy. The second is related to long-term investment horizon is another key features of SWF that makes them particularly valuable for India's economic development. Unlike many private investors who may seek short-term gain, SWF often have the ability to make investment with longer gestation period. This aligns well with the Indian infrastructure and development needs, which often requires sustained long-term funding commitments. The next is again related to diversification, that is crucial strategy employed by SWF to manage risk and optimize returns. For India, this translates to investment across various sectors such as infrastructure, real estate, technology, and financial services. This diversified approach not only helps SWF spread their risk but also contribute to the balanced development of different sectors in Indian economy. The impact of SWF investment on Indian asset under management goes beyond mere numbers. These investments often bring with them experts, global best practices, and potential for technology transfer. Moreover, the presence of SWF can act as a catalyst, attracting other funds for foreign investment and boosting investors' confidence in market. Now we shall discuss the most popular investment, that is equity investment. The equity investment have become a cornerstone to India's asset under management landscape, driven by the country's economic growth, rising incomes, and evolving financial markets. The equity investment sector in India encompasses both direct equity investment and equity mutual funds, each playing a crucial role in the overall asset under management picture. Direct equity investment involves or institution buying shares for companies listed on stock exchange. This form of investment has gained popularity among retail investors due to increased accessibility through online trading platforms and growing financial literacy. Direct equity allows investors to have more control over their portfolio and potentially higher returns, albeit with the higher risk. Equity mutual funds, on the other hand, offers a professionally managed route to equity investments. These funds pool money from multiple investors to invest in a diversified portfolio of stocks. They have become increasingly popular due to their ability to provide diversification and professional management, especially appealing to the investors who may lack the time or expertise to manage direct equity investment. The regulatory reforms have played a significant role in shaping the India's equity investment landscape. The Security and Exchange Board of India, that is SEBI, has implemented various measures to enhance transparency, protect investors' interest, and improve market efficiency. These include stricter disclosure norms, the introduction of direct plans in mutual funds, and the regulations to curb insider trading. Such reforms have boosted investors' confidence and attracted more participants to the equity markets. Rising income in India have been a key driver of growth in the equity investment. As disposable incomes increases, more individuals are looking beyond traditional saving instruments to grow their wealth. Equity investment with their potential for higher returns have become an attractive option for the growing middle class seeking to build long-term wealth. Now we shall discuss the most popular investment, that is equity investment. The equity investment have become a cornerstone to India's asset under management landscape, driven by the country's economic growth, rising incomes, and evolving financial markets. The equity investment sector in India encompasses both direct equity investment and equity mutual funds, each playing a crucial role in the overall asset under management picture. Direct equity investment involves or institution buying shares for companies listed on stock exchange. This form of investment has gained popularity among retail investors due to increased accessibility through online trading platforms and growing financial literacy. Direct equity allows investors to have more control over their portfolio and potentially higher returns, albeit with the higher risk. Equity mutual funds, on the other hand, offers a professionally managed route to equity investments. These funds pool money from multiple investors to invest in a diversified portfolio of stocks. They have become increasingly popular due to their ability to provide diversification and professional management, especially appealing to the investors who may lack the time or expertise to manage direct equity investment. The regulatory reforms have played a significant role in shaping the India's equity investment landscape. The Security and Exchange Board of India, that is SEBI, has implemented various measures to enhance transparency, protect investors' interest, and improve market efficiency. These include stricter disclosure norms, the introduction of direct plans in mutual funds, and the regulations to curb insider trading. Such reforms have boosted investors' confidence and attracted more participants to the equity markets. Rising income in India have been a key driver of growth in the equity investment. As disposable incomes increases, more individuals are looking beyond traditional saving instruments to grow their wealth. Equity investment with their potential for higher returns have become an attractive option for the growing middle class seeking to build long-term wealth. In spite of all these options, the investors in India largely rely upon the fixed income investment. Fixed income investment play a crucial role in India's asset under management landscape, offering stability, regular income, and capital preservation to investors. This sector encompasses various instruments including direct bonds, bank deposits, and money market instruments, each contributing significantly to the overall fixed income in asset under management in India. The first is related to the direct bonds that allows investors to lend money directly to corporations or government entities in exchange for regular interest payment and the returns of the principal at maturity. In India, government securities and corporate bonds are the primary types of direct bonds. The government securities are considered the safest fixed income instrument, while corporate bonds offer potentially higher yield with a varying level of risk. The bond markets in India has been growing with increased participation from both retail and institutional investors. The next is related to the bank deposit that remains one of the most popular fixed income investment in India. These include saving accounts, fixed deposit (FDs) and recurring deposit, that is RD. Bank deposits are favored for their safety, that is backed by deposit insurance up to the certain limit, liquidity and easy of access. They form a significant portion of household saving in India and contribute substantially to the fixed income asset under management. The next is money market. The money market instrument are shorter term debt security with maturity typically less than 1 year. These includes treasury bills, commercial papers and certificates of deposit. Money market instruments are crucial for managing short-term liquidity for both investors and issuers. They offer relatively low risk and provide a slightly higher returns compared to the saving account. The significance of the fixed income investment in India asset under management landscape underscores the importance of these instruments in providing stability to investor portfolios and facilitating capital formation in the economy. As the market continues to evolve with the introduction of new products and increased retail participation, fixed income investments are expected to play an increasingly vital role in India's financial ecosystem. Now we shall discuss the most attractive investment for the investors in India is gold and the precious metal. Gold and the precious metal holds a unique position in India's asset under management landscape, driven by the cultural significance, role in portfolio diversification, and evolving investment options. The sector has been significant development with the regulatory changes and the introduction of new investment vehicles like gold bond. The cultural significance. Gold has been an integral part of India's culture for centuries, valued not just as an adornment but also as a store of wealth and symbol of financial security. This deep-rooted cultural affinity translates into substantial household gold holding estimated at over 25,000 tons. While much of these is in physical form, there are growing trends towards paper gold investment. The next is related to diversification. Gold and other precious metals serve as an important diversification tools in investment portfolio. Their tendency to move independently of stock and bonds makes them valuable for risk management. In times of economic uncertainty or market volatility, gold often acts as a safe haven, attracting increased investment. The next is related to the policy change, that is regulatory changes. The Indian government and the regulators have introduced several measures to monetize gold and promote more efficient forms of gold investment. These include the gold monetization scheme, which allowed individuals to deposit physical gold and earn interest, and stricter norms for hallmarking to ensure quality standards. The growth trajectory of gold and the precious metal investment, particularly sovereign gold bonds, that is SGB, has been impressive. Between 2019 and 2023, the asset under management of gold ETF and SGB combined more than tripled, outpacing many traditional investment categories. This growth has been driven by factors such as increased awareness, the ease of investment through digital platform, and the attractive features of sovereign gold bonds, including the tax benefit and interest payment. Looking ahead, the potential of further growth in the gold and the precious metal asset under management remains strong. Factors such as economic uncertainty, inflation concerns, and the ongoing appeal of the gold in Indian culture are likely to sustain interest in the gold investment. Additionally, as more investors seek to diversify their portfolio and explore alternative to physical gold, products like SGB and the gold ETFs are well positioning to see continued growth in asset under management. Now we shall discuss the most controversial investment in India is related to the crypto investment, that is cryptocurrency investments. Cryptocurrency investments have emerged as a controversial yet potentially significant component of Indian asset under management landscape. Despite regulatory uncertainty, there is a growing interest in the emerging asset classes driven by its potential for high returns and the increasing global adoption of digital currency. The first is emerging asset class. The cryptocurrency led by the Bitcoin and Ethereum represent a new asset class that has gained attention worldwide. In India, despite regulatory challenges, a significant number of investors, particularly young demographic, have shown interest in cryptocurrencies. These digital assets are seen as a potential hedge against the inflation and the currency devaluation, as well as a way to participate in the global digital economy. The second is related to the regulatory uncertainty. The regulatory environment for cryptocurrency in India has been volatile and uncertain. The Reserve Bank of India has expressed concern about the potential risk associated with the cryptocurrency, including their use in illegal activities and their impact on monetary policy. While a banking ban on crypto-related transactions was overturned by the Supreme Court in 2020, the legal status of cryptocurrency remained ambiguous. This regulatory uncertainty has been a significant factor in limiting the growth of cryptocurrency asset under management in India. Potential for the growth. Despite regulatory challenges, the potential for growth in cryptocurrency investment in India is substantial. The country has a large tech-savvy young population that has shown enthusiasm for digital assets. Additionally, India's growing startup ecosystem and technological sector could potentially benefit from the adoption of blockchain technology and cryptocurrencies. Looking ahead, the potential for further growth of cryptocurrency asset under management in India remains uncertain but significant. Factors that could drive growth includes regulatory clarity. If the Indian government establishes a clear regulatory framework for a cryptocurrency, it could lead to increase the institutional and retail participant. The next is related to the global adoption. As the cryptocurrency gain more mainstreaming acceptance, globally it could influence adoption in India. Next is related to the technological advancement. The technological advancement, improvement in the blockchain technology and development of use cases beyond speculation could drive interest. And the last is related to the economic factor that concern about the inflation and the currency devaluation could push more investors toward the cryptocurrencies as a store of value. However, it is crucial to note that the future of cryptocurrency investment in India heavily depends on the regulatory development. The government's stance on the cryptocurrencies will play a decisive role in determining whether they become a significant part of the India's asset under management landscape or remain a niche high risk investment category. Well, this is the last slide of my presentation, and here we discuss about the financial literacy and awareness, which is the most neglected part of Indian investors. Financial literacy and awareness have become a crucial factors in driving the growth of asset under management in India. As the country's financial market evolve and diversify, there is an increasing focus on educating the population about the various investment options and the financial planning. This push of the financial literacy is significantly influencing the asset under management landscape in India because it has never been taught in the school, colleges, etc. The first is related to the government initiative. The Indian government have recognized the importance of the financial literacy in achieving inclusive growth and has launched several initiatives. The National Strategy for the Financial Education, that is NFE, spearheaded with the Reserve Bank of India and other financial regulators, aims to create awareness about the financial product and services. The Pradhan Mantri Jan Dhan Yojana has been instrumental in bringing millions of unbanked individuals into the formal financial system, creating a foundation for further financial education. The next is related to educational programs. Various institutions including bank, stock exchange and mutual fund companies have launched educational programs to improve financial literacy. This program covers topic range from basic budgeting to complex investment strategy. The Securities and Exchange Board of India, that is SEBI, has been particularly active in conducting investor awareness program across the country, focusing on both urban and rural areas. The next is related to the creation of the digital platform. The rise of the digital platform has played a significant role in democratizing financial education. Mobile application, online courses and the social media channels are being leveraged to reach a wider audience, particularly the younger demographic. The fintech company have also contributed by simplifying financial concept and making investment process more user-friendly. Looking ahead, the potential for financial literacy to further impact of asset under management growth in India is significant as more individuals become financially literate because of the following reasons. The first is there is likely to be shift from traditional saving instrument to market-linked product, potentially adding trillions of asset under management. The second reason is the penetration of the mutual funds and the direct equity investment in smaller cities and rural areas is expected to increase substantially. The next is related to more sophisticated financial products like REITs, infrastructure investment trust, and ETFs are likely to see increased adoption. And the last is the overall quality of investment decision is expected to improve, leading to a better long-term wealth creation. The success of financial literacy initiative in contributing to the India's asset under management underscore the importance of education in driving financial inclusion and the market growth. As these efforts continue and evolve, they are poised to play a crucial role in shaping India's financial landscape, potentially transforming millions of savers into the informed investors. Now, in the end, we would like to draw your attention that so far we have discussed various methods of investment and asset under management. Now it becomes apparent to know how much is being invested for asset under management in India with the options available. So stay tuned till next week for an interesting topic: progress and prospect of ESG investment for asset under management in India. Till then, I wish you all a happy and prosperous day, and wherever you are, please stay safe.